Will the Fed pivot to appease the markets? Welcome to another episode of SRT Live with me, your host, Sean Richard of the Sean Richard Mortgage Team. Glad you could join me today. And boy, oh boy, I feel like I've been saying this every single week, but we have a blockbuster week ahead of us. We've got the Fed meeting going on today and tomorrow. We've got the BLS jobs report at the end of the week. We've just got a slew of economic data and goings on this week. And believe me, it's going to be market moving. We're going to see some volatility in the markets starting tomorrow and through the end of the week. So let's get into it. First and foremost, let's talk about the week in review. Last week, we had a pretty packed week last week. We got new home sales, which came in at an annualized pace of 603,000. This was higher than expected, which the expectation was 585,000 from economic analysts. So came in with a beat there. However, it was down from the previous month of 677,000. So 603,000 annualized pace on new home sales. I think we're going to continue to see that dip a little bit over the next couple of months as home builders start to slow down their pace of build based on a pending recession. We also got pending home sales, and this was a big one. This was actually a big miss from the pending home sales market, and this came in down 10.2% month over month. So what does that tell us? That tells us that home sales are slowing. Now, we can easily say, okay, well, Sean, the interest rates have been rising, especially since June when they the first time that they peaked, and we're seeing demand slow down. And I think that's 100% correct. We are starting to see demand slow down. I say starting. We've seen demand slow down for the last couple of months now, and it's showing up in the reports. Remember, this report is for the month of September. So we're a little bit of a lag there. The expectation was coming in down 5%. We doubled that. So home sales slowing down. As always, last Thursday, we got the jobless claims or unemployment claims. As a reminder, if you're watching me for the first time, unemployment claims broken down into initial claims, individuals filing unemployment for the first time, and then continuing claims, individuals renewing their unemployment benefits. So initial claims came in pretty close to in line with expectations, just a hair under. Expectation from market analysts was 220,000 jobs week over week. We came in at 217,000 claims, and this was up slightly from the prior week's reading of 214,000. So we're staying in that low 200,000 level of unemployment claims. Continuing claims, however, jumped pretty dramatically from 1.38 million all the way up to 1.43 million. So we saw a 50,000 jump in continuing claims, individuals retaining renewing their benefits. So we'll as always, we want to keep an eye on unemployment claims as it pertains to the strength of our jobs market, our employment market. Now, this was a surprise. We got the first reading of Q3 GDP. Just as a reminder, if we flash back, we got a negative Q1 GDP reading, a negative Q2 GDP reading. Q3, we got the first of three readings, came in at a positive 2.6 expansion. So this is the first of three readings. So we want to keep an eye on this as we head into the GDP reading in November, and then the third and final Q3 GDP reading that we get in December to see if this shrinks or if we stay relatively robust in that low to mid 2% range. But this is definitely a dramatic turn from the negative readings that we got for the first two quarters of the year. We also, that's the news from last week. Now, this week so far, it's been, we started off with a semi-quiet news week, but we did get the JOLTS report. And this measures job openings. And so again, just looking at the strength of our labor market, job openings surprised to the upside. We actually got a reading of 10.7 million jobs, 10.727 to be exact, job openings. But as I've said before, one of the things that doesn't really tell us in this report is Are these truly unique and individual jobs, or are some of these jobs posted across multiple states because we have a work from home environment for a lot of companies and industries now? So the numbers may be a little bit inflated, but it's always something that we like to take a look at. Again, monitoring the health of our employment market. Now, here we go. Drum roll. This week, starting tomorrow, we get the Fed finishes up their meeting, and we're going to get the Fed funds rate decision. Now, the expectation is that we're going to see a 0.75% increase to the Fed funds rate. As a reminder, the Fed funds rate is the short-term overnight bank-to-bank lending rate. It does not have a direct impact on long-term lending, such as mortgage rates. It's going to impact things like your credit card rates, your auto loan rates, personal lines of credit. It's going business lending. It's going to impact those types of lending products. It's also hopefully going to have an impact on your savings rate. You know, your bank may decide to give you a little bit more interest on your savings when the Fed increases the Fed funds rate. So we get the Fed funds rate tomorrow, expected 0.75%. Of course, as always, when we get the rate decision, we're also going to hear from Jay Powell himself, Jerome Powell, and this is going to be key. I'm going to talk about this in a moment, but we really want to pay attention to what Mr. Powell has to say tomorrow. Now, this is all on Wednesday. Tomorrow, on Thursday, as always, we get our jobless claims. We're going to take a look at unemployment for last week. And then on Friday, we get the huge market moving Board of Labor and Statistics jobs report, as well as accompanying that is the unemployment rate. So this is going to be big. We really want to focus on what is unemployment rate doing. Have we bottomed out? One of the items that are one of the documents, or I guess graphics, that I want to show you. Here we go. Check this out. I'm going to share this with you. Here we go. Boom. Unemployment versus recession. Oh, that didn't do me any good here. There we go. Let's see if I can make this bigger for you. Here we go. Boom. All right. Unemployment versus recession. So these, as you can see, the darker vertical lines are recession since going back to the 60s. Well, here we have the unemployment rate. Well, look at where we were right before every recession. Low unemployment, recession. Low unemployment, bottomed out, recession. Unemployment, bottomed out, recession. Bottomed out, recession. So as you can see, now, past performance, not indicative of future returns, but when we have this type of consistency over a 60-year span, it's really hard to ignore these indicators. So employment has bottomed out ahead of a recession every single time going back into the 1960s, and we are at a low point in unemployment. Employment's been sitting at the lowest levels that it has been in quite some time. And so will we end up in a recession? I think the answer is likely yes. I know there's a lot of political talk about that in the economy right now in society, but it looks like it very well could be the case. The other thing that I want to show you, some really cool data here, is when it comes to inflation. So inflation, one of the things that we are heavily focused on an ongoing basis, but especially as we head into the inflation reports coming out in November for the month of October. And the reason for that is we just finished up right here. So October, we got the inflation reports, CPI, Consumer Price Index, and PCE, Personal Consumption Expenditure. In October, we got the reports for the month of September. So this 0.3 dropped off because these are 12-month rolling averages. So we just finished with the summer. We just dropped off these three very low inflation month-over-month readings. And we are looking at core, which strips out food and energy. So starting in October, look at these month-over-month readings: 0.6, 0.5, 0.6, 0.6, 0.5. Now dipped in March, but then jumped up again April, May, June. So we're going to be replacing some relatively high month-over-month inflation readings as we continue every month. So the November CPI reading is going to be a very important one. It's going to give us an indicator of whether we're going to start to see inflation decline. And so the November CPI and PCE inflation reports are going to give us a lot of information. Now, sadly, the Fed is meeting yet today and tomorrow. They don't have the luxury of seeing those reports prior to making their decision, but we could see inflation start to decline once we start getting those reports this month and going forward. All right. Now, what else are we paying attention to? We are paying attention to Fed talk. Thank you for coming to my Fed talk. And we are paying attention to what Jerome Powell is saying. We want to see, is the Fed going to pivot from their aggressive stance attacking inflation? Right now, we don't have any data that really indicates that inflation is starting to come down, although the writing may be on the wall with some of the information that I just showed you. So the question is the Fed going to pivot? There's been a lot of pressure on the Fed to calm down or to slow down their aggressive nature on inflation. The consensus, or I guess some of the commentary in the marketplace, is that the Fed is aggressively hiking to the point where they're not giving their those rate increases time to filter into the economy, and some believe it's putting us in a position where the Fed is going to end up overcorrecting and pushing us into a deep recession. And so, are we going to see the Fed pivot? We are expecting that 0.75% Fed funds increase tomorrow. I don't think the Fed is going to stray from that. Would be a surprise if they do. If they happen to only give us 0.5%, expect the markets to rejoice. But I don't see that happening. But more important than the actual Fed funds increase is, what are we going to hear from Jerome Powell at his press conference tomorrow at 1 o'clock Central Time? That's what we want to pay attention to words coming out of his mouth. So that wraps us up for today. I want to say thank you so much for joining me on SRT Live. I'm your host, Sean, with the Sean Richard Mortgage team. If you're checking us out on the Powerhouse private Facebook group, thank you so much for being an amazing part of our community. If you're watching on our YouTube channel, make sure to smash that subscribe button, so that way you've got real estate and economic data at your fingertips every single week. If you have any questions, reach out to me at the phone number below, or you can always leave comments. Have an incredible rest of your day and your week. Take care.